For the latest in strategic affairs, subscribe to our YouTube channel. Click the bell icon for more updates.
Did you know that the Government of India is scheduled to borrow rupees 11 lakh crore this year? Did you know that the Government of India is poised to float a 50-year debt paper? Hello and welcome to another edition of Capital Calculus. I'm your host Anil Padmanabhan. A few weeks ago, India was included in the JP Morgan Global Bond Index. This is a big deal. It's something akin to an equity being included in the Sensex or the Nifty 50. Overnight, it becomes a very valued and sought after investment. Something similar is likely to happen to a certain class of sovereign government bonds, especially since everybody in the world seems to want a bit of the action. To unpack the implications, we spoke to Saugata Bhattacharya. He is a senior vice president at Axis Bank and one of the keenest watchers of the Indian economy. I began by asking Saugata as to why everybody is getting so excited about India being included in the JP Morgan Global Bond Index.
The JP bond market, the emerging market GBI EM bond index, this has been in the works for a long time. It's been almost 10 years now. It came in, if not all of a sudden, there was market chatter that JP Morgan, the bond index run by JP Morgan, was considering India in the index. Remember, this is a very large pool of funds. The JP Morgan note press release mentioned that they have assets in that particular bond index over $236 billion. So that's a fair bit of money. And more than anything else, the fact that they requested India to be included in the index without India actively having requested this is just a vote of confidence in the India's economy, the fiscal discipline, the macroeconomic stability, etc. So that's a very clear signal to domestic and foreign investors, which is, I think, the biggest news of it all.
Interesting. So, Saugata, how does this instrument work? In the sense, these are called passive funds. So then are they like investing in an index which is linked to the Sensex or something like that?
No, you're absolutely right. This is exactly the bond market equivalent of how you describe the passive funds, the indexes in the equity markets. So, for instance, assume the reason that this is called passive is that if you say, for instance, an investor has 100 billion worth of AUM in his or her portfolio, and they're looking to invest in the index, and India has a 10% weight, say, in the index, then 10 of the 100 billion odd funds will get automatically invested in that particular index, bond or equity index. So it's passive in the sense that this tracks the index, and the portfolio allocations are allocated automatically into that index. This is different from active investing, where you actually pick and choose the securities that you want, whether equity securities or bond securities, and that's why it's called passive investing.
So, Gato, you said this is like in a coming of age moment for India, because JP Morgan pursued India to be included in that index fund of theirs. So my question is that are there other similar funds out there?
Yes, there are indeed.
And have they approached India similarly?
So that information, Anil, I'm not privy to. So whether some of the other funds, but yes, there are other large funds. In the bond market space, there are essentially three large funds. One is the JP Morgan, the bond index. The other two, the big one is the Bloomberg fund. And the third one is the FTSE Russell fund. So these are the three large funds in the index. From what the information that is available in the public domain, the Bloomberg index is the largest, and the JP Morgan is in between, and the FTSE Russell is probably slightly smaller than the funds. But that's based on public information. But yes, there are other smaller indices but these are the three large conglomeration of funds. And remember that we are only talking about the JP Morgan emerging market bonds. I mean, so there are multiple other subsidiary, smaller, linked associated funds. We've just heard in the press release that the JP Morgan ESG fund is also linked to this index. So these are the smaller funds, but these are the three large groups of bond market index funds.
So, Saugata, you mentioned that they've been pursuing India for nearly a decade. So, I'm curious, about the timing, and did this delay occur because India had to full check some boxes, make some policy changes to make this possible?
So, a few things on this. One, the first thing that you asked about the timing. Why now? At this point in time, although this has been in the works and multiple negotiations have been taking place sequentially over a period of time. So my presumption is that at this point in time, because Russia has already been excluded from many of these funds, these indexes, people are now a little bit worried about China, the ongoing developments in China, etc. So India is the only large market, large pool of funds, investable funds in the bond market space, in the sovereign bond market space, that still was not part of the funds. On top of which, India bond market yields, say the average, the 10-year security now at 720 or whatever, so that the yields in India are more attractive compared to many of the other emerging market participants in that bond index. So I guess because of that space that had opened up because of Russia and China, and because of the attractiveness of these securities. And remember, these reviews are done every 6 months or so. So, I mean, at this point in time, I think India's credentials as a fiscally responsible country with a good macroeconomic, stable background, economic background, I think all of these came together propitiously at this point in time for JP Morgan to be asked to be included in the index. That although these negotiations have been happening, and this is, remember that this has been a steady progress over a period of time. Remember in 2019, I believe, April 2019, RBI introduced the first set of VRR instruments, the voluntary retention routes for some of the government sovereign securities. And then in April 20, they included the fully accessible route, the PAR set of bonds. So this has been an ongoing process. At this point in time, this came in. And the second point to remember is that there have been no special concessions on either the tax rates, the withholding taxes, capital gains taxes, or even the operational the aspects of managing these securities, say integration into the Euroclear settlement systems, etc. So even without this, this proposition has come.
So this special window that RBI created is not for all government securities, right? And secondly, these are fully convertible. It's like a fully convertible capital account, so they can invest and take it out if they want to, right?
That's right. I mean, there are no limits to the holding of these securities. The fully accessible route for securities. I presume that from approximately the total issuable the volume of these 31 FAR securities is notionally about 27 lakh crores, 27 trillion rupees, of which FPIs currently hold an approximate 1 lakh crore, 1 trillion rupees in some of these PAR securities. There are no limits to the holding. And as you mentioned, these are fully capitally convertible. You can put in as much funds as is available in the notional amounts, and you can pull out funds. You can exit the funds. There are no capital controls on these FAR security investments.
So, from what you just said, what are the kind of flows we can expect from this fund, through this fund, once it kicks in from next year onwards?
That's right. So the schedule that's been put out in the press release is that India's limit will be approximately 10% of the GBI EM bond index, incrementally rising from 1% in June 2024 up to March, say, incrementally up to cumulatively up to 10%. So just on an approximate basis, if the total AUM for this particular index, GBI EM index, is about 236 billion, then presumably roughly should be getting somewhere around 20 to 23 billion in over the period.
It is clear then that the inclusion of India in the JP Morgan bond index is going to lead to an inflow of funds into government securities. I was curious to know as to how this would impact the government's cost of borrowing.
So presumably, I mean, given the bulk of investments that the government issuance program, etc., say around 11 lakh crores, 11 trillion rupees net issuances. So over a period of time, this will not be a significant part of the total issuance programs. And remember, when somebody is buying, somebody is automatically, on the other hand, selling the securities. So that demand-supply balance more or less balances out. The other thing that we need to watch in this, that typically till now, FPI bond investors into India typically seem to have invested in lower maturity, shorter term securities, bond instruments. The list of FAR securities, the fully accessible route security, these have a higher longer maturity, the duration, as it's called in bond market jargon, and that will tend to push out the tenor of the securities upwards. So I mean, the duration of the Indian securities bond holdings, that will probably tend to increase. And remember, I think that's a desirable outcome. Particularly yesterday, when we heard the proposed issuance of a new 50-year security. So the government also is probably trying to push out the maturity, the profile, the duration profile of the outstanding bonds into longer dated securities.
So, a logical corollary is that it should also lower the cost of borrowing for corporates, because normally their loans are linked or indexed to the sovereign bond, right?
Absolutely, absolutely. Because the sovereign, particularly the liquid sovereigns, the 5-year, the 2-year, 5-year, 10-year, 15 years, which are the ones that are the most heavily traded, these become the benchmark for that entire set of interest rates, everything. So on these maturities, the corporate bonds, other bonds, special bonds, etc., these become benchmark to these. They have their own independent demand and supply dynamics, but essentially at the most fundamental level, the 10-year benchmark for the Indian government securities, the IGBs as they're called, G-SECs, that becomes the benchmark for the shape of the yield curve of corporate bonds, the AA's, AAA's, single A's, triple B minuses, everything gets linked to the sovereign yield curve.
So will this, all these developments from what you just laid out for us, the JP Morgan index, this 50-year duration that India is attempting, will this broaden and deepen the debt market, making it more mature as opposed to what it is now?
I presume it will. I think you're right that because you get a set of new investors pulling in a significant amount of money into the system. So presumably liquidity in the bond markets will probably increase because I mean FPIs, unlike the contractual long-term holders of securities like insurance companies or provident funds, etc., tend to be more have a deeper trading bias. So they will facilitate price discovery in the market. Liquidity will increase. The spreads, the trading costs as they're called. I mean, the bits, the buy sell bid amounts. Those will improve. So the spreads, the trading impact costs will begin to come down. So presumably, I mean, this will turn out into a very positive development for the Indian bond markets. Indian bond markets, particularly for the deeply traded securities, the 5, 10, 15-year papers, they are already pretty liquid. I mean, the spreads, the bidding spreads are quite small anyway as it is. But any further deepening of the markets, any further increase in the liquidity of the markets is always a welcome step. So always a welcome.
So Saugata, I just want to move to the aspect on the impact on the balance of payments. These kind of inflows should have a salutary impact, particularly in terms of current account as well as, of course, the capital account.
Yes. So primarily it's the capital account because the current account will be driven more by. So if the fundamentals of India as is signaled by the inclusion in the bond index begins to improve, our growth will probably go up. Given what we have seen from the savings data, the financial savings of households, of corporates, etc., we will probably need larger capital flows, foreign capital flows. The pool of foreign capital will need to be accessed to fund India's higher investments, government, private, household investments. So we will need more capital. So one particular corollary of that is that for maintaining a certain degree of stability in the currency markets, the current account deficit that India is running will also probably need to increase. Of course, I mean there are limits because, as RBI mentions regularly, repeatedly emphasizes that there is a sustainable limit of the current account deficits at 2%, 2.5%, 3%. But given the scale of investments that will be needed to propel India's growth sustainably to 6.5%, 7%, we will need more foreign capital, part of which will be coming in from the debt markets. And obviously, as we speculate that the yield curve will shift downwards, interest rates will begin to fall. And remember that at some point in time, the RBI will also probably get into a rate cut cycle. The global environment will stabilize. Global central banks will also pause, then begin to cut rates, etc. That will lead to a risk-on environment, higher growth. That will also begin to pull in equity capital into the country. So there are multiple macroeconomic ramifications that will happen, basis both the inclusion part as well as the evolving macroeconomic interest rate dynamic situation.
It is clear then that the inclusion of India in the JP Morgan Global Bond Index is a big deal. Among other things, it will help solve key macroeconomic pain points in India. But most importantly, it's a global vote of confidence in India. Thank you for watching. Don't forget to subscribe to StratNews Global on YouTube. Hit the bell icon so that you don't miss any updates. And if you like the show, please hit the thumbs up. And if you have any thoughts, ideas and suggestions for us, please do get in touch with us. I'm available on Twitter at Capital Calculus. I'll be back next week with another episode. Till then, stay safe.